Oh, hello, it's Susie again from Esoteric Trading Solutions. I hope you're all well. Just like to point out what technicals I use when I'm trading markets. Look, I've used these technicals for over 30 years, since 1987. I've used them in trading all different markets, whether it be bond markets, fixed interest, foreign currency, equities, and now crypto markets. And I find these work best for me. But I will stress, it's really up to you as a trader, what sort of trader you are, to what sort of technicals you use. Everyone uses their own types of technicals. Some people don't use technicals at all, and it really is a very much a personal preference. I find the technicals for me work very well. We had a couple of trades on the other night where we were short Ethereum and we were short Litecoin, and obviously the market kept moving down from our 292, I think it was, on Ethereum, and Litecoin we were short at $61 or so. So as the market kept moving down, we basically moved our stops down and locked in some profitability as the stops moved down. So it was a risk-free trade where we locked in profit. And then if the market went back up again, we'd already locked in that profit, which was very nice. Plus we picked up some Ripple around 0.1830, which I was pretty happy with as well, because as you know, I'm very bullish Ripple. But anyway, let's go back to the technicals. Again, as I said, it's a personal preference to what technicals someone uses. But these are pretty much the technicals I use, and we'll go through them, and I'll just tell you why I use them personally. But so what I do use, obviously, is I use price action, I use time. I don't know why you can't see that there, time, but anyway, time, price action, parabolic SAR, sometimes Bollinger Bands, sometimes pivots. Pivots I do use, fractals, MACDs, balance of power with histograms, Ichimoku clouds, and I use a risk return or a return risk ratio as well. So time frame for me is very important. I tend to use the 4-hourly and the daily for crypto markets particularly. In the FX market I used to do the same thing, and the equity market, but generally in the equity market I would use shorter time frames. So it might be an hourly for the equity market or a 30-minute, but again it just depends on what market you're actually trading. But when I'm looking at the crypto market or even the currency market, I will look at a 4-hourly, I'll also look at the daily, and then I might drill down to the shorter time periods, being a 2-hour, 1 hour, and potentially even a 30-minute, but that's pretty much it. When I make a decision whether I go short or long, I tend to look at the 4-hourly. That's pretty much what I do look at as a time frame, particularly for crypto markets. Obviously, price action is very important. So I look at the direction of price action, whether the price action is green or whether it's red, pretty much the movement and the different patterns of that price action is making, whether it's large wicks, small wicks, whether they're fat, whether they're long, that sort of thing. So price action is pretty important. Some people don't use any sort of indicators, and that's fine. I mean, some people just use price action. As you can see, it's going down and it's going down again. So that price action to me looks pretty negative, down, up and down, up, down. So again, some people don't use indicators, they just use price action, and that's fine. A thing that I do use is the parabolic SAR. I've always used parabolic SARs ever since I've been trading, and I do like them very much. Some people call them the stop and reversal indicator, and effectively they have dots. So for example, down here, where it pretty much says the trend's developing and you should be on the buy side. On the top side, if you have dots above the price action, you should be selling, essentially. So I really, really like that indicator. It comes out fairly early on the price action, and it pretty much tells you that you should be selling pretty quickly or buying pretty quickly. Bollinger Bands, again, sometimes I use them. They are used by professional traders. I do use them. I'm just aware of them, and I will have a look at them. And you can work out, you can go and get deep definitions of what these things are in terms of, them being a moving average and less the standard deviation or plus the standard deviation or whatever. A lot of professional traders do use these. I've used them. I don't go by those fully. I'm more inclined to put a lot of emphasis on the pivots, which we'll come to, and on the Ichimoku, which we'll come to, as well as the parabolic SAR. So Bollinger Bands, basically, if it hits the top end of the Bollinger Band, it means the market's overextended, so you sell it. If it hits the bottom of the Bollinger Band, the market has been oversold, and so you buy it, pretty much. I don't know why these are all out of whack a little bit, just in terms of the graphs, but anyway, it's not a big deal. I do like pivots. In the Forex market particularly, professional traders, institutional traders use pivots. I use pivots, and pivots are pretty much, there's all different types of pivots, and you can look those up. But essentially, they're basically support and resistance levels. Now, the market very much, in the FX market, foreign exchange market, and I do find it in the crypto market, really trades to these pivot levels. If you have a look at Bitcoin on the quarterly, on the 4-hourly or even the daily, it literally, when it got to that high of 6184, 6186, it traded absolutely to the pivot level, literally, and then it sold off. You'll notice that when support breaks a big level, it's normally a pivot level. It could be a Fibonacci pivot or just a standard pivot. I use pretty much standard pivots, but honestly, the market very much trades to these pivot levels, and basically the institutional or the professional traders use these pivot levels, and I've always used them, and I love them. I think they're great. Sometimes I use fractals. Fractals basically, again, can identify reversals in the market, but I also use them for stop losses. For me, as you can see down the bottom here, the price action shouldn't get there if you're right, so I use fractals very much for stop losses. So if I'm going to buy here, where it's forming a base, just where I'm pointing this little thing, I'll use the fractals to tell me where to put the stop losses on a wide stop loss. So I do like the fractals for that, pretty much. MACDs I like as well. MACDs is the difference between the 26-day exponential and the 21-day exponential moving average. It's not a weighted moving average. So exponential means it gives more emphasis to the recent moving averages, not the weighted average. So when the MACD gets to a high, like up here, you sell it. When it's down here, you buy it. You buy the price pretty much. Again, sometimes I use balance of power and histograms. And again, with the histogram, if it's red and it's below the 0 line, the market is selling down. And often you can see with the histogram that once it gets that rounding base, it's nearly time to buy. Also with the balance of power is an indicator that basically tells you the buy and sells in the market. If that indicator goes below negative and goes to below 0 and goes to negative, then obviously the sellers are in power. If it starts to go towards 0 and positive, then the buyers are in control of the market very much. But my favourite indicator, I guess, of all time is the Ichimoku clouds. Now, a lot of people look at this and they go, wow, this is just too much, I can't handle this. But when you look at it, it's pretty easy. Now, every Japanese trader I've ever known trades with these technicals, the Ichimoku clouds. They trade them in the foreign currency market. They trade them in the bond market. The Japanese market is the second largest market compared to the US, particularly in US yen, of course, but also they have a very, obviously the Nikkei, the equity market's huge, plus, the foreign currency market and the bond market is huge. They're the second largest market in the world. So the professional traders trade with Ichimoku clouds. Now, I really like these clouds because it gives you something. When you look at this stuff, it's really fast. You can look at stuff pretty quickly. Most of the lines are based on simple averages, 9-day high and 9-day lows. There's only one line that's based on a 26-day high and low divided by 2, and this is the baseline. So this one here. So pretty much the clouds will tell you whether the price action is negative or positive. So in other words, if you've got green cloud here where I'm pointing, the price action here is positive and the price action is above the green cloud. So that's quite positive. If that price action started coming down towards the green cloud, that green cloud is also a level of support. So the fatter the green cloud, the more level of support you've got. Another thing, if you've got a red cloud, it basically says this is a level of resistance. The price action is under the red cloud and it's a level of resistance. So anywhere where price action gets to a red cloud, where it's very, very fat, like this one, the market price action is going to go through a fair degree of resistance. So see here where you've got a red cloud and it's not very fat, you know that it's not a very strong resistance line. Now, often these clouds will match up, depending on how that they are, they'll match up with the pivot lines, and that's why I use a combination of pivots and these clouds, and I like them both very much. So as I said, you know, you've got your 9-day high and low divided by 2, you've got your 50-day, which is a longer analysis, divided by 2, which comes to 26-day, 26 and 26. So pretty much when these indicators are all sloping upwards, it's bullish. When the indicators are sloping downwards, it's bearish. This indicator is a shorter indicator. The blue, that because it's on a 9-day, it'll start pointing up much quicker than obviously the 26. But that blue indicator, as it points up and it crosses the red, is basically telling you to buy. So the price action is moving up and the blue indicator is moving up a lot faster. And pretty much through this red, the resistance is very low. So, you know, that's quite bullish. Once it broke the red, that tells the market to keep buying, because there's no more resistance until later on. So they're the indicators I use. So let's go back to my charts. And as you can see, basically a 4-hour and a daily. And, you know, I use a combination of all those, but you will see that those Ichimoku lines, you know, give you a really good idea of resistance and support, and certainly the pivots do as well, and the professional market looks at those. And pretty much, you know, I tend to use the 4-hour and the 1-day time frame, but I will often, you know, go to lower time frames as well. But I do like that, and also the parabolic SAR. So there's probably 3 indicators I like particularly, is the pivots, the Ichimoku, which I have trouble saying, and the parabolic SAR. So another thing I also look at is return and risk. So very quickly, if you're putting a trade on, you really want to put a trade on where you're only risking 1 unit to get 3 or better. So what I mean by that is, say for example we wanted to sell Ethereum, and say Ethereum was at 345. My stop loss would be at, say, 365. So I'm risking 20 points, or $20 I should say, $20. And if I'm expecting a move to 285, then obviously 345 less 285 is 60. So, and I'm risking $20, so $60 divided by 20 is 3. So my ratio becomes 3 to 1. I generally try and work on that. Anything under 2 is pretty much too skinny. I hope this helps. I hope you're trading well, and look forward to speaking to you another time. And I do hope this helps. Thank you.